Mr. President, Chairman, ladies and gentlemen, it's a great pleasure and an honor for me to speak at this prestigious event here in Jerusalem. Let me take off from where the previous speakers started also. We saw also in 2007 a massive reduction in liquidity in money markets. We saw it from the other side, not from the bank side. We saw it from the central bank side. And our first intervention as a European Central Bank was the most massive one the institution had ever undertaken since its start. Since then, we had several rounds of tensions in money markets, but we didn't really have a widespread crisis. A widespread crisis came when Lehman Brothers defaulted and went into bankruptcy. From that moment on, the tensions that were limited to the financial markets and to banking in particular both affected the emerging market economies in a very rapid fashion. There was a worldwide deterioration of economic conditions, and what used to be a financial crisis became a full-blown economic crisis, the worst recession in post-war history. Now, when I look back at what happened really after Lehman Brothers, my view was this was a crisis of confidence. And it was not just a crisis of confidence in other parties in financial markets. What we saw in many discussions with the banks, it was a crisis of self-confidence in money markets. Banks simply moved to panic mode after the default of Lehman Brothers because nobody knew whether they were able to save their own institution, let alone have trust in the ability of others to save their institutions. And I think this really caused a major crunch in credit availability immediately. Finance markets dried up, liquidity dried up, and central banks had to intervene in an unprecedented scale and scope in these markets. Now, the central bank intervention, in my view, was only done to buy time. And we did that in Europe too, as our American counterparties. We bought time for governments to act. And as you know, some of the government action programs, like the bank rescue programs, or the conjunctural programs need to go through a legislatory process. And just to give you an example, the fastest law ever passed in Germany, post-war history, was the bank rescue program. It was passed through both houses, upper house and lower house, within a week. Usually, parliamentary processes in Germany take up to a quarter of a year, run on regular schedule. So it was a massive intervention, very much front-loaded in time. Now, where do we stand now? Financial markets, optimism is now again more widespread. There is significant improvements in many market conditions, stock market prices, spreads, bond yields, all of these have improved. They have improved even more so than the real economy, which I find somewhat concerning. The situation, in my view, is still fragile, and I don't rule out that temporary backlashes are likely to occur. Now, you also have to understand that stabilization is not just due to better macroeconomic performance and the leveling off of risk aversion. It is also due to unprecedented intervention and stabilization measures on the part of the government and the central bank sector. Banks are still exhibiting weaknesses, and I think that at least for most of our domestic exposures, the strong recession that we've just seen in the corporate sector will lead to further bank losses, not in the part of structured finance in banks, but on the part of domestic credit exposures. It is usually happening a half a year after the downturn in the economy, so I expect the next 2 years to be basically characterized by some major losses also in banks' balance sheets due to domestic exposures. And also, Stan mentioned at the start, there is still high levels of uncertainty in the markets. Volatility in markets is still high, and I really fear that this is not the point for renewed irrational exuberance. Now, for me, I want to touch on two things. Given this analysis where we stand, where do we go from here? I think it's fair to say that the worst is probably over in financial markets. However, given that, I think before optimism returns in full-blown fashion, we only have a small window of opportunity for all the reforms of the financial sector that are needed in order to not have the same situation again that we saw. The consequences of the crisis have created, at least at the G20 level, a urgency and a willingness to act mode that is unprecedented, and it must be put into action now. We owe this to the public, this is my firm view. The immense cost of this financial crisis that were imposed on public finances and on future generations simply demand that things like what we've seen cannot happen again. Now, there are two areas that I'd like to focus on. First is on banks. Banks are still the primary link between financial system and the real economy. It is true that regulation and oversight have to be extended to all systemically relevant parts of financial institutions, so we need to deal also with the banking and the shadow banking system. But better regulation for banks, in my view, is the most important building block of a new financial stable system. And it is essential to improve banks in all dimensions. First, we need better risk management practices. We need better capital, and better capital means we need higher levels of capital in banks, and we need better quality, full risk absorbing forms of capital to cushion against future losses. And this crisis has shown liquidity is not always available at almost zero cost, so banks need to economize on liquidity, and we need liquidity requirements within the framework of the regulatory standards like Basel II. Now, we also need to address the causes of the crisis, and that means we need to not just modify the regulatory framework, we need to take banking supervision one step further. What do I mean by that? We need to take banking supervision in an era where it is insufficient to safeguard the stability of each individual bank at the microprudential level as regulators. That is fine, but macroprudential issues are very important, so systemic risk needs to be identified and combated. A good picture to show how this works is if you look at the strengths of each link in a chain, each link may be solid, but the strength of the chain is always only as strong as its weakest link. And this is what we've seen in the banking industry. We need to improve systemic supervision. We need to improve macroprudential aspects in supervision. And as Stan said before, I think central banks are the core institutions that have all along focused on macro issues and macroprudential issues. And this is, in my view, one of the reasons why central banks will around the globe get a larger role in banking supervision to basically bring macroprudential aspects into microprudential regulation. We also need to flesh out the details of the new regulatory reform. We need a consistent framework that is the same across the globe. And I represent Germany on the steering committee of the Financial Stability Board. I can tell you, if we do not succeed on having similar global standards on banking supervision, on capital requirements, on liquidity requirements, and a convergence of the accounting framework, we will fail with banking supervision to prevent things like the ones that have happened now. Because we will be under the illusion that things that look the same are the same, but if you look deeper, they're not. And this is an important issue for me, so whatever we can achieve individually is fine. Whatever we can achieve globally is decisive. And the new banking supervisory standards will only be as good as what we agree globally to impose in all our systems. Now, let me also add a few words on the way forward. On the way forward, it is important to say where we stand now is very much driven, in my view, by politics. Politics has issued a systemic insurance for all players in the market. And it has taken things much too short to look only at institutions that have profited directly from intervention by central banks or by governments. Everybody has profited. A fall of major financial institutions would have led to a devastating effect on all financial institutions. And the key issue for the future is how do we take out this implicit put that is now in the market? So exit strategies are at the core of what we need to discuss. We need a credible exit framework in three dimensions. First of all, central banks need a credible exit. And I think that credible exit, in my view, will be warranted and will be implemented in my view, not such a difficult fashion. For us central banks, price stability always was the primary objective. It will remain the primary objective. And in the heat of the crisis, I was very often confronted by two schools in Germany saying, the one said, there is deflation ahead. And the other school said, there is massive inflation ahead. And it was roughly half and half of the observers of the central banks asked, what is your likely outcome? My answer was, the most likely state in the future will be price stability, because we have independent central banks, we have a clear mandate, we're willing to execute exactly this mandate. We will not be popular when we do this, but we will do it nevertheless. This is why we were given independence. And so for me, the most likely thing in the future, in terms of description of central bank outcomes, will be sustained price stability even in the years ahead, which will be difficult years. But we need an exit also for fiscal policy, and I think that exit is much more difficult. Fiscal policy has blown up deficits in an unprecedented scale. We need to structurally rebalance these deficits. Most of the deficits we've seen are structural. So the hope that future growth will undermine these deficits is simply not warranted. We need structural adjustment to move to balance. And therefore, we need to cap deficits, we need to basically consolidate the budgets, we need to restore confidence in public finance, we need new room to maneuver for future policy, and let me tell you, coming from Germany, we need to prepare the budgets for the immense fiscal burdens of aging that will face our society. And if we don't do that in time, we will simply pose higher and higher costs on future generations, which in my view would be devastating for the acceptance both of policy and of the dealing with this crisis in the eyes of the future generations. Thank you for your interest.